Swing points are fundamental concept in technical analysis in forex trading. Hey guys, welcome. Today we are talking about the swing points, which are the swing highs and the swing lows. So, in short, in layman terms, the swing high is just a peak, as you can see, and the swing low is just a valley, as you can see here. These swing high and swing lows, they represent a temporary points where the market momentum has paused and reversed its direction. As you can see here, we were in a bullish momentum. Then we temporarily reversed our direction and we started selling. Same to the swing low here. We were selling, now we started buying. That's what we mean by the reversal. Okay, now this for the swing highs. Now let's look at the swing high. A swing high is just a candlestick or a price chart that has at least one lower high on both sides, on the left and on the right. At least one. If there are two, better. The lower highs we're talking about, this is the high. As you can see, let me use this marker. This is the high we are talking about. Now these are the two lower highs, as you can see. Lower high, lower high, lower high. Now this becomes our swing high. Let me mark this for you. This the highest point price reached. This becomes our swing high. This becomes this becomes our swing high. Now this swing high, it indicates a point where buying pressure was overcome by selling pressure. So the buyers could not push price any higher, and so the sellers took place. Now the market started reversing downwards. Same. Now let's look at the swing low. For the swing low, it's just easy. You have to identify at least one higher low on both sides, on the left and on the right. As you can see this here, this is our peak. The lower highs we are talking about is this. The lower high, the lower high. One, two, or at least one. Let me mark them for you. So this is our swing low. There is a higher low and there is a higher low on both sides. Now this becomes our swing low. Let me mark this for you. This becomes our swing low. So this indicates that, or indicates a point where selling pressure was overcome by buying pressure. As you can see, sellers here were in control. Now the buyers or the bulls came into the market and reversed the direction. I guess that's all. Now let's look at why these swing high and swing lows are important. Number one, we use them to identify a trend. For uptrend, we make a series of we make a series of higher low, higher low. And for a downtrend, we make a series of lower low, lower high, lower low, lower high. The next thing we use these swing highs to do is to identify our support and resistance. For the swing highs, we identify our resistance point, and the swing low, we identify the support zone. Also, we use these swing highs and swing lows to place the stop loss orders. So we just place them either above the swing high or below the swing low. We also use them for risk management because the distance between a swing high and a swing low can help us measure the market volatility and determine the appropriate position sizing for the stop loss. Now let's dive into the market and identify a few swing highs and swing lows. I'd already done that. Now let me delete so that we can identify. As you can see here clearly, this is a swing high. This is the highest point the price reached in this period. So you can see there's one lower high, there's another lower high. This is another swing high. There's lower high, lower high. This is also another swing high. There's a lower high and there's a lower high. Same to this point. This is the peak. There's a lower high. There's a lower high. Now let's try to identify a swing low. Let me first start with the obvious ones. This is a swing low because this is a swing low because we have another higher low. There is a higher low, there is a higher low. Same to this, it's also a swing low because we have a higher low, a higher low. Same to this, we have a higher low and a higher low. This is also a swing low. We have a higher low and a higher low, as you can see. And that's it.